very, very uncertain about what's going to happen this week. Guys, it was just announced that we've had 11 weeks in a row of outflows in investing. What does that mean? It means people are pulling more money out than putting money in. Is that a good or bad thing? Well, it all depends on which way you're looking at it, right? My goal here is to teach people that there's data out there and it's your job to react to that data. You're not trying to guess what's going to happen unless you have very good, reliable data that shows what the future is going to hold, right? But right now, with the outflows, what that means is when people are taking money out of mutual funds and out of ETFs, the people who run those mutual funds and ETFs are forced to sell assets to pay them out. When that happens, stock prices are going to come down. So even if values are good, if there's outflows, it's making stock prices go down. If there's inflows, the people in those ETFs and mutual funds are forced to buy more stock. And what does that cause the stock prices to do? It causes them to go up. So the same thing's going to happen when the outflows are coming. The exact opposite thing is going to happen. It's going to make the stocks go down. Is that a bad thing? I don't think so. Why? Because I believe in buying great companies at great prices. So if you're new to this channel, I'm Paul. I'm a value investor. My job is to look at assets and use our 8-pillar analysis to decide what to screen and how to look for these companies going forward and pick the companies I want to buy. I use a quantitative approach. I focus on the numbers. And from there, it weeds out all the crap so I can then focus on the qualitative aspects of the business, the quality businesses that I want to own. I'm just here teaching my process, and that process can speak to you. But the main key here is, as a value investor, my goal is to look for when price and value are disconnected. I want to find a place where price is lower than long-term value because of the emotional reactions and uncertainties in the market. It happens all the time. Sometimes it takes longer than most. We've had a 5 or 6 year bull market run that was on the end of a 7-year amazing run that I think took us into bubble territory. Does that mean that the world's going to fall apart? No, we've had bubbles so many times in history. There's always a bubble going on at some point. Your job as an investor is to acknowledge when that's happening and make decisions based on it. This week is a very, very important week in investing. Let me show you what's going to happen out there. These are all the data points coming out this week. Tomorrow morning, 6 a.m., the small business index, 8:30 a.m., the consumer price index. The small business index is looking to go from 89.9 and stay steady. The consumer price index is going from even, so this is CPI, inflation, to actually a reduction in costs, okay? Now watch for our videos tomorrow because we'll be posting a video tomorrow very early, right after this data comes out, that will explain this. So make sure you subscribe to the channel so you can watch these videos. On Thursday, initial jobless claims. They're estimated to go from 222 to 225. Retail sales and retail sales excluding vehicles are supposed to come out too. Now, this is really important. Why is it important? It's important because 70% of GDP is consumer spending. And what do consumers spend on? Retail. So we want to see how is retail doing. That's super important for the GDP, for US economy. If people start to retract their spending, it will cause GDP to fall. And then finally, the Philadelphia Fed Manufacturing Index. This is an index that keeps track of how manufacturing is doing in the Philadelphia area, which I believe includes Pennsylvania, New Jersey, and Delaware. I'm not exactly 100%, but it's only one small set of the country, but it's important because it'll show us how is manufacturing going. Now, here's the issue. It did a 6.2 rating before, and now it's dropping to 2. Anything above 0 is growth, and this is still growth, but a slower growth rate. And then finally, Friday at 10 a.m., the University of Michigan, go blue, Consumer Sentiment Index. What they do is they call consumers and ask them, how do you feel about your personal financial situation? How do you feel about the short-term economic situation? How do you feel about the long-term economic situation? And it's actually expected to increase from 58.2 to 59.3, which is still very low in terms of historical, but we hit historical lows recently and we've gotten a bump up because of inflation being a little more tame and stock prices going back up again. So these are really important aspects. And I want you to understand that even though these things are short term, the only reason I'm going to watch them personally is I want to look and see if anything surprising comes out. I look at all this data as an indication of where the economy is going because I'm waiting for better opportunities to buy. And if we're sitting here and you look at stocks and where they were a year and a half ago versus today, and you look at the high-flying hype stocks, just go look how they've been doing now. When all of a sudden, it took a minor slowdown in the economy to all of a sudden send all these stocks crashing because people changed their buying habits. And that's what's important. I'm trying to teach a long-term approach to investing. Don't worry about the small changes here or there. If this index comes in at 59.2, don't freak out. When a company reports $1.44 in earnings per share versus $1.45 expected and the stock falls like crazy, don't freak out. Wait for the ideas that say what's going to happen in the long run. If the company comes out and warns and says, hey, listen, we created this product, we put a lot of money behind it, and it failed miserably, that's something to look at and say, okay, why did they fail? Go understand those things. Don't get bogged down in the small week-to-week, day-to-day, month-to-month issues. Look at the long run. Go look at history. Go look at every crash and every recession, everything that's ever occurred. If you could go back in time and invest all the way down as it fell, would you do that? Your answer is 100% absolute yes. So this is exactly why I created this channel. We created this channel to teach a long-term approach because I saw how many people were getting so bogged down in day-to-day decisions on investing for the long run. We believe in dollar cost averaging into low-cost market-based ETFs. But if you watch our channel, there's a lot of individual videos on individual stocks. So why do we do that? Well, I still believe if you believe in a process and you do it well, take a portion of your money and put it towards individual investments. But also, more importantly, it's about that mindset. The mindset is so important for long-term success. It's one thing to say you're going to dollar cost average. It's another thing to get excited when stocks are lower, that you're buying at lower prices. This community we created here, we have this entire community that we created. And one of the best things we did with it was create that in order to talk about mindset. Because successful investing isn't about the numbers only. That's about 20% of it. The rest of it is mindset. How do you operate as an individual when it comes to stock prices falling? Do you believe your money's going to zero? Because a lot of people do believe that when they buy, when there's a stock market crash, oh my gosh, Paul, stock market's going to zero. Imagine that. Me just saying that right now sounds so ridiculous, but guess what? It's a true statement. People really believe that. So, if what I'm saying makes sense to you and you want to have a different approach to how you view money, subscribe to the channel, watch us. Thank you very much. And please watch our next video, which is about the upcoming recessions could be an opportunity of a lifetime. Thank you very much for your time.